About the only thing traders in the bond market agree on, and I've been canvassing them, is that the collapse in spread has taken them by surprise. Take a look at what's happened just since November 28th. Well, first of all, here's the reasons why they talk about the idea that there's the old recession signal, which everybody knows, and it's a good one, by the way. But there's also the it's different this time idea, which is that the Fed holds a big portfolio of stuff. It's selling it off. Also, trade progress reduces near-term inflation concerns from tariffs. That would be another reason. Technicals, I don't know about you, but it feels like every year in December, I have to remind people that it's the end of the year. And that you get all these trades around it. Currencies and bonds and stocks, they all make year-end movements. So one thing I heard yesterday from a leading bond guy was that you have pensions are out there, and they felt like when the Fed became more dovish, that's the last bit right there, it made it okay for them to go into the long end of the bond market and make some purchases. Also, they were locking in year-end gains. Their funding gap was closed, so they said, all right, I'm locking in these gains, I'm going into long end. It's technical stuff, but it happens around the end of the year. Let's see how we got here to this thing. This is just the change of November 28th. 14 basis points, a massive change. We came down 2 on the 2-year, 2 basis points, but 12 basis points on the 10-year. And that's where maybe you can see that trade. Well, what happened? The Fed became more dovish.
That's the November 28th was when Powell spoke?
In and around there. Now, here's some of the commentary that I'm reading, and it's just a little bit of the commentary. Let me tell you, there's a lot out there. None of it really comes together. JP Morgan writes, markets have been either pricing in a Fed policy mistake or end-of-cycle dynamics, and there still appears to be more flow support for the Fed policy mistake hypothesis. They raised too much on the front end. They cause inflation to tail off. Here's Peter. Bookvar says it's almost as if the bond market screamed out, quote, it's too late. The growth slowdown underway can't be reversed. That's in response to the trade agreement. Tariffs are still with us, and now we have to wait around another 3 months. So there's a tariff explanation there. And if that weren't enough to worry about, as Joe indicated earlier, ADP will happen Thursday. You get the jobs market on Friday. We're still expecting 200,000 jobs. It is, I think, mathematically impossible. You can get people off the sidelines. If you're going to do 200,000 jobs over a sustained period of time, you know what's going to happen? The unemployment rate's going to fall. Right. Now, you tell me how the market's going to react if you get to a 3.5%, 3.4%. You could be, and along with strong wage gains, we could be talking on Friday about the Fed being back in the game.
Ugh.
And didn't the Wall Street Journal today suggest that
now I get to walk away from this
back in the game, right?
Yeah, that's right. I was going to say, see, you know what bothers me about the yield curve movement of late is that when you look back, it isn't that the Fed raises rates to invert the curve. It's always the bond market inverts the curve while the Fed is raising it. Right. So this is what's been going on of late. All the rest of the flattening was the normal type of flattening. The market was doing fine with it, yields going up. But now the bond vigilante for the first time is really suggesting a more of a recession signal by them looking to invert the curve. That's different. That's something new, and it comes at the time when corporate credit spreads have blown out too, and that combo is a bit unnerving.
I was just going to say, you didn't mention the 5-year is really where the furious rally has taken place.
Yes.
Right? It's gone from 309 to 281 in less than a month. So that's kind of what we're talking about, this short end.
Can I explain why I didn't do that? Because I don't have a long-term macro signal off of the inversion of the 3 and the 5.
And there isn't one.
I can't play that game because I don't know how to play it.
That's my point. It was a positioning thing in 5 years partly.
And by the way, one thing worth mentioning is that the Treasury financing the deficit has been doing so very much in the way of the bills market and on the short end. And people I talked to yesterday said they don't understand why the Treasury isn't more terming out the debt. But in any event, the deficit's coming through. We need to finance it. It's been happening on the short end, more pressure there, less on the long end.
Can I just ask very quickly? We said earlier that the inverted yield curve has predicted 7 of the last 7 recessions. Has it predicted 21 of the last 7 recessions, or is it pretty accurate? And if it happens,
it has predicted a couple that didn't occur, but it's been pretty accurate. At least the longer.
Once you get to the 2s versus 10s.
Yeah, 2s, 10s, or 30s cash, or those kind of.
So it's also the issue though is the time period from the inversion to
the recession.
It can be long and variable, as the Federal Reserve might say. The other issue is the Fed is actually focused on a different spread. It's the Fed funds to the 2, I
Yeah,
think it is.
the very short
The
end.
very short, and that's the one they think is the better
And right
signal.
now, it's the 2 years saying you have 2 or 3 hikes in there, you'd be okay.